Hi everyone, I'm Deepika Singh. I'm the CMO here at Quantel, and we have with us today Sreenivasan. He's our CEO and founder, and he's a man of decades of experience in the Wall Street space. He's a finance veteran, and he's here to share with us, advanced strategies around tax loss harvesting.
This is a very, very dear topic to a lot of people. And if you understand how you can save on taxes today, it's going to save a lot of dollars, the real economic benefit for a lot of folks here. People who work in a company for a 5 year, 10-year horizon, they get a lot of compensation in RSUs and ESOPs. Companies like Amazon, companies like Salesforce, Expedia, Microsoft, all of these companies are very generous with the ESOPs and RSUs. And if someone knows how to save on taxes to defer it, they could save a lot of money. And this topic is actually very, very pertinent for quite a lot of folks who have been, invited for this webinar.
Absolutely. I think we have a very curated audience here today who really understand the impact here.
So one thing I would say is for those who are attending this webinar, um, this is not for everyone. This topic is obviously going to be impactful for those who have quite a lot of capital gains on their company stocks. They have single concentration risk that they have. Quite a lot of wealth is stuck in that company stock, and company is not doing as well. I can give a lot of examples. In the recent past, most of the Max 7 companies have really staggered, have been, stuck in one particular point. They've not been able to move ahead. A lot of other tech companies like Salesforce are in the same kind of boat. So this is for those folks who have got quite a lot of concentrated positions in their stock holdings. And this also applies for people who have been like investing in a single stock over many, many, many years, buying the same stock. While it's good, right? There's quite a lot of capital gains that gets added over a period of time, and now they are stuck. How do I get out of this to diversify? Because if I sell, I'm going to pay a lot of taxes. How do I avoid the taxes? So this is also good for those folks. And the
Right.
last case is for those people who are having a business right now and they're planning to exit the business in 5 years. Clearly, they're going to have hopefully a huge profit, like 5, 10, 100x of what they have invested. How do you reduce your taxes? You can't completely avoid it, but how do you reduce taxes? So this is not for everyone. If none of these cases are touching upon you, I would say you can still listen in, learn a lot about tax loss harvesting for a future use, but it won't be immediately impacting you. So this is, I think, time well spent, understanding about tax loss harvesting for those who really get impacted on that one.
Right. And I think Sham, from the poll, we understand that some of the people here attending today have exposure to tax loss and harvesting, but some do not, or some are superficially aware about it. So maybe we start off with a leveler where you talk to us about like what is tax loss harvesting and who is it for, so
Yeah.
that we're all on
So,
the same page.
right. So, as I said, who is it for? It's clearly for people who have quite a lot of capital gains on their existing portfolio, right? This is any kind of capital gains. Mostly, we are talking of capital gains in equity market, in market as a whole, but it doesn't need to be restricted to that. It could be a house sale that there's a lot of capital. You may have house as a secondary property where you're selling. If you're not planning to buy another house, then you have to pay capital gains on that one. So it's broadly capital gains. It's not really restricted to stocks and mutual funds and stuff like that. So that is for who is it for? The What
Right.
is tax loss harvesting? So there's a common misconception that tax loss harvesting means it's avoiding taxes. It is not. It's a perfectly legal way of deferring what would be considered as taxes to be paid on a capital gains this year to a distant future. How distant it is, it's up to us, right? It's up to the account holder in terms of how far you want to push it out from a tax loss harvesting point of view, right? You keep accumulating your losses that is a day-to-day occurrence, right? Market moves up, market moves down. Today, the market is down 2%. Market will be up 2% tomorrow, right? So it's being smart about using the downward trend in the market churn, benefit the losses on the books without worrying about the gains. Let the gains stay there. But losses are accumulated in the books by reinvesting the stock, the amount, the proceeds immediately in a similar kind of stock. So, in a nutshell, it's about being smart about how much becomes your realized capital gains at the end of the year, right? A tax year is between
Yeah.
January 1 and December 31. So how smart can one be? And we use a lot of algos. Have our own proprietary algos to do it. It is a very involved process. If you have a job to do, you're not going to be able to do tax loss harvesting as efficiently as what an algo can do or what we can do as professional investors. So there are some differences in terms of how tax loss harvesting can be done. There are simple way to do it, more advanced way to do it, etc., and somewhere in between. So it is about being smart about taxes. That's all it is. It's not avoiding tax, it's deferring taxes. Yeah.
Yeah, that's a good one. And I think what is important to understand is also, right, that what's hurting like the audience in terms of your current state, like what is your biggest barrier in implementing tax loss harvesting at this point?
From my perspective, as I said, the biggest barrier is the sophistication that is required to
Mhm.
efficiently do tax loss harvesting. The most simple way of tax loss harvesting is anyone can do it, right? You just invest in the entire S&P 500 basket, right? 500 stocks. By there are lots of tools that's allowing you to do 500 stocks in one go, right? But S&P itself keeps changing, so you have to keep up with S&P's composition changes, the weight changes, and all those things, right? That's one problem. But at the end of the year, on December 30th, we can wake up and say, hey, anything that's negative returns for me this year, just sell it. So you
Right.
harvested your losses, right? Thereby. What can you do in a typical end of the year kind of cycle? You can do probably about 3% of your overall portfolio value as harvested. I mean, we are doing the math in terms of like simulation and all those things. It's not a big deal for all that effort that you took to invest in 500 stocks to get an S&P return. Great, but what you get out of economic benefit is not worth all that effort you took, right? So there are better ways to do it, and time is the biggest barrier. Knowledge is the biggest barrier. The knowledge as in where to invest, how to invest, when to sell, how to sell, right? All those things are the barriers in my perspective of trying to implement it on your own. So there are lots of algos that many companies have developed, the Betterment kind of companies have developed. Again, the difference is in the sophistication of these algos.
Fantastic. And I think, Sham, it would be really helpful if we jump straight into, like, how we do it, right? And what are the results we've actually seen? What are the different strategies we've implemented? So maybe, we can start off with discussing a case study or different scenarios where, the audience gets a clear feeler and, insight into what we're doing and how you're doing it.
Right. So I would give a very high level of various different ways tax loss harvesting can be done, and I won't do it more than 2 minutes, right? So the first is the traditional tax loss harvesting, which I mentioned. A lot of robo advisors do it. You can buy a basket of S&P 500 stocks, right? It's not SPY ETF. You can just buy S&P 500 stocks. They manage it of what the 500 stocks are going to be. On a periodic basis, they would look at which of these stocks have got any negative return at all, and then basically take it out, meaning sell it, and thereby realize the losses. That's a very simple way of doing it. So if you say S&P has got a 10% positive return for this year, in reality, it would be about 15% in positive side and 5% on negative side. And it could be anyway, right? 15 minus 5 is 10, or it could be 20 minus 10 is 10. So there are going to be some stocks which is negative return, some stock which is positive return. So end of the year, you get a set of negative returns taken out, and then you have S&P's return, but have a little bit of harvested losses. Very, very simple way, very inefficient way, not very, what to say, impact creating way, right? That's a traditional tax loss harvesting. The second one, which we do, is the enhanced tax loss harvesting, is take the portfolios, but don't focus on 500 stocks. It doesn't make sense. There are lots of stocks which is highly liquid, highly volatile, a lot of momentum there, a lot of growth there. It can in fact exceed the returns of S&P 500 as that basket, right? Think of it as a growth basket, growth portfolio, high momentum portfolio, which is driving the market, and that keeps changing at different cycles of the market. So you want to achieve at least S&P 500 on books. The net profit of that portfolio should be at least S&P 500. But along the way, every day the market churn happens, and you basically take anything that's got a negative return of a reasonable size. Let's say 10% drop from the point that you invested, because it's highly volatile. You can get a 10% drop also, right? It's a basket of stocks. Take it out, get that 10% loss in your books, which is basically harvested. Invest that amount that proceeds immediately in a comparable stock, so that you get the similar kind of high growth, high momentum. So you're not going to lose out on the growth of the portfolio, but do it in a smart, efficient manner. And that's where you need a lot of sophistication of picking the stocks and using an algo. The last one is a little bit more complicated, which a lot of hedge funds do. We have also started doing on a very high value portfolio. It's called a long short overlay. You take let's say $1 million portfolio is there. You take a $300,000 margin, do a long and short. Net exposure to the market is zero. All you are trying to do is benefit from both the negative prediction on both the long side as well as the short side. Basically, the acceleration happens on the harvesting part. Instead of harvesting 10% per year, you can harvest at 20 to 25% per year. So that's a little bit more involved with use of margin and long short, etc. So that's in a nutshell what a tax loss harvesting is. Go ahead, Deepika.
Fantastic. Yes. So I think Sham, it would make sense to actually dive deeper into the case studies part of it, in the sense that, can you walk us through some examples which clarify the impact tax loss harvesting can make for different individuals
Sounds good.
across
Yeah,
different
I would
time?
take one example here, right? This is a real live example that we have, right? We have a client who has more than $1 million of one of the Max 7 companies, right? Max 7, as you know, is Microsoft, Amazon, Apple, Google, Nvidia, and so on and so forth, right? A lot of these Max 7 companies have stuttered this year. In the long run, they are still a very, very good, large cap company to hold. But in the short run, they have not done well. Some companies have actually struggled over the last 3 to 5 year period, right? So I would say, and this can be said with not the Max 7 also, like Salesforce. Quite a lot of folks from Salesforce are in this call too. The last 5 years, it's got a negative return of 30%. So it's not really moved anywhere. So when you think your portfolio that the company has offered as part of your compensation is $1 million that you work for 10 years for the company, is like stuck there. It's not giving you the market returns, which is S&P's return. By S&P's return standards, you would have doubled that money in that 5 years period, right? But it's not double. The 1 million is stuck for the last 1 year, 5 years. What do you do? And that's basically where this thing is coming in, right? So you can think of your gain of $1 million, your what you invested or what you were given at a stock price to where the stock is. Think of it as 50%. It could be 200%, it could be 500%, depending on the stock. If you were an employee of Nvidia 10 years back, you're probably looking at about 10, 20 times where your actual contribution is. Your average price is going to be really, really minimal compared to where the stock price is, right? So the effect of the capital gain is humongous in most cases, as it should be, right? So I'm just taking an example of 60% capital gain here, which is $600,000 of your $1 million is not coming from your pocket, but the market has given you that return. Now, if you take a tax due in a typical federal taxes level, it's about 23.8% for a typical executive level compensation, right? Because this comes under the long-term capital gain, and then there is NIIT, there is, some income related taxes that they tag on for a high value or high net worth client, investor or a customer. So 23.8% is the tax rate from federal. Now add on the state taxes. State tax can be anywhere between 0% in fortunate, tax places like Texas and Florida and New Hampshire, etc., or it could be up to 13% in some states, like the state that I live in New Jersey. It is considered an income. New York, where I work, it's considered an income. You not only have New York tax, but also Yankee tax or city tax, etc., right? So there's a lot of taxes that gets added by the state. Your 60%, your 23.8 suddenly becomes almost 40% of your gain will be taxed. So I've taken a 23.8% example of 600K. So your tax dues is about 142K, let's say 150K. Again, if you live in New York, it would be close to 250K, not 150K, right? That's a lot of money, $250,000. So you cannot get out of those positions for the fear of paying a huge amount of taxes. So what you can do smartly is, hey, I don't want to give up my stock. My company is a great company. I don't want to pay taxes, but I want to be smart about it. How do you become smart about it? You have this dormant $1 million of your company stock sitting in your books. Take a 30% margin on that, right? You brokers allow you to take margin because you've got a huge collateral. You could even take 40-50%, but let's say to be on the safe side, we'll take a 30% here, right? $300,000 is a lot of money for you to deploy that money from a tax loss harvesting point of view into the market, right? So I would say a typical harvestable amount in a $300,000 or any amount, right? 100,000, 200, 300 is about 20% of the value of the portfolio can be harvested as loss because of the day-to-day churn that happens, right? Every month you can do about 1.5%, but it's a sliding scale. As you start investing in a portfolio of stock, there are going to be some stocks that is going to be profitable. You can't get out of it. There are some stocks which is negative return. You get out of it and invest in something else. So it's basically like a tier down structure that you can't get the same kind of tax loss harvestability towards the end of the year period. But net, you can get about 20%, 15 to 20%. If the market churn is a lot like now, you can get a lot more. If market itself goes down, let's say market S&P is down 10%, you can get the benefit of it. You don't have to sweat out that, oh, market is down, that's fine. You can use that as the harvesting opportunity because what goes down is the market will eventually come back. So you don't have to really sweat about it. Those are additional opportunities that you get to harvest the losses so that the harvested amount can be used to offset the gains that you have, right? So there the logic is, if you have a $60,000 of loss harvested, what does it translate into in terms of your company stocks? I said before that 60% is the gain. That means your company stock is $100,000, right? So you can get $100,000 worth of your company stock out in a single year. With $300,000 overlay, the margin that I mentioned before, you can get $100,000 worth of your company stock reduced. You don't need to do it. You can keep harvesting. The good thing about tax rules is that there is no limit on how many years you can accumulate your losses. You can accumulate as long as you want. And one fine day, you can say, "Hey, I've got enough losses in my tax harvested that I'm going to take all of it out to reduce my taxes to zero on my company holdings." You can do that. So the loss harvested will never go waste. It'll permanently be there in your books that you can carry forward into next years and so on. So this is a way you can mitigate your impact on single concentration. The company stock that you hold, continue to hold it. Whenever you decide to reduce, if the company stock is doing good, keep it. If company is not doing great, reduce a portion of it because you've got the harvested amount. You're not going to pay even a single penny tax if you have enough harvested for the portion that you have exited out of the company stock. Does it make sense?
Absolutely. Yes. One of the key things, while in parallel, what Sham we need to talk about is the impact of tax loss harvesting in long term wealth creation, because there are multiple wealth goals people have, right? And in that, TLH becomes one of the key differentiators in which like $1 million and a $3 million wealth goal can differ. So that is what would you say about that?
Yeah, so the example I gave you before, right? The $1 million of a company stock, if the company stock is not doing well, if it's underperforming the S&P 500, then your wealth is not growing, right? You have to do something about it. What do you do? One way of doing it is the tax loss harvesting I mentioned, where you can slowly chip off your company stock into a more broader, diversified portfolio of growth, and then start getting at least as much as S&P or more return, right? Once you start diversifying, you've got the option to accelerate your portfolio and think or look beyond your company stock, right? The company stock is, going through the roof. It's doing great. You don't have to do anything. It'll automatically fetch. But at some point, the drumbeat will stop, right? Any company, right? At some point it'll, and that's where you want to have the ability to have harvested losses, because you're not doing anything to harvest the loss. All you're doing is use the margin to harvest the losses and keep it in your books. When you want it, you've got your solution ready there. You've got enough harvested stock to offset a decent chunk of your company stock, move it into a growth portfolio that can accelerate your return. So that is a
Absolutely.
key differentiator, because if I have a company stock at $1 million that was valued at $1 million 5 years back and it's not done anything, technically it should be $2 million, right? But it's not done anything,
Right.
right? I'm stuck. So where will my wealth grow? So this is one way of saying I don't want a concentration risk. At least let it be there, but I have a choice of when I don't want the risk or when I want to have the risk, right?
Right.
It's all based
And I
on my
think,
company's
Shah,
performance.
one of the things I think from what you said, what cues off is that a lot of senior, executives, when they're talking about, looking at their own portfolios, one constant observation around the worry that they have is how to deal with volatile markets. And
Mhm.
this is, I think, one of the, conversations we've also had recently where Quantel actually reviews the tax optimization opportunities. Do you want to shed some light on that?
Yeah, so when we look at a portfolio of stocks, right, there are clearly going to be some stocks which, one may consider as long term, but it may immediately give a short term opportunity for us to harvest it as a loss. Again, I would not sweat when market gives you these ups and downs, but I would definitely sweat if my company stock is going down, because for a company to revert back, it takes multiple quarters to prove to the investors that they are actually doing good, right? Because if a stock has gone down significantly, 40, 50%, and we have seen this, a lot of examples, for them to come back to their previous spot, it will take years. If you don't have that amount of patience, that number of years to wait out whether it's going to happen or not, clearly you are stuck in that mode, and that's where I would be worried. But if I have a more broad, diversified portfolio, that what goes down in a year will come back in the next year, right? That's just a typical trend of the market. If you were to follow the market as a whole, you don't need to worry too much. In fact, for a tax loss harvesting portfolio, market going down and giving the churn is actually a good thing. What I invested
Mhm.
last month, if it's given me an opportunity to take off, harvest 3% today, I'll take it off, invest in something else which is also going to be in a similar kind of league. When the first stock that I sold is going to come up, the second stock most probably will also come up, right? And that's a typical kind of a correlation, trend that would happen. So where I invested, I would also get it back to almost the same situation. But this churn
Mhm.
has given me the opportunity to harvest more, right? So again, the market going down or these individual stocks, going down during that, cycles of ups and downs, it's nothing to be worried about. In fact, it's a good thing for a harvested tax loss harvesting account.
Yeah.
Our goal is the account as a whole should beat our benchmark, right? That is our goal. While it's beating the benchmark, we also want to harvest about 20% of the portfolio's value in tax losses, right? So that churn that I mentioned before, right? That the net value, if somebody has invested, let's say $200,000, we want that $200,000 to grow at least at the rate of market. Let's say market is 10% for easy calculation. It's about $40,000 to $20,000 on 200,000. You want the 200 to have become 220 but 220 is the value of the book, whereas you also have harvested about 20% of 200, which is $40,000. The tax value of $40,000 is about 23%, as we said before. It's quite significant, right? So
Right. I think one of the things which you mentioned earlier, Sham, at the beginning, was around the different situations that tax loss harvesting can be used. So, for example, there's a founder or a senior executive. Maybe they're happy today with the kind of portfolio they have or the basket they have, but they do have maybe a plan that in 5 years' time they would like to exit, right, or offload. What can they start doing today for tax loss harvesting so that they're not like thwarted under capital gains?
right. So the first case is you have the stock, you want to de-risk from your company's portfolio. That's very straightforward. You're just taking some margin, you can trade on the margin and create the harvesting opportunities and all, right? The second is people, I know a lot of our clients who invest in the same stock over and over. S&P 500 as an example, right? SPY. Just blindly put the money into SPY and don't worry about any individual stock. Just keep putting as a dollar cost average or DCA, put a $500 every month. That's also one way of growing the stock's value, no questions about it. But when you do that over many years, naturally the average cost is going to be much lower than the current price of whatever you invest in, whichever stock you invest in, right?
Right.
As long as the stock is not a dud, right? So you will get a lot of capital gains there. But how do you diversify, or how do you get more growth? How do you not get stuck with that one position or one stock that you invested in, right? And that's also a second case where you can use the same concept as the first one, use a margin and do it. The third one is slightly different because here you're talking of a founder of a company. They've invested all their money, right? They've taken a lot of sacrifice. They've taken a company from X to a 10x value, right? Now, for 10x value is going to be the capital gains, right? For them, right? For in terms of how much they're going to have to pay taxes when they eventually exit. And these exit opportunities don't give multiple phases. You exit out, in most cases, it's like immediate, realization of capital gains. So you have to plan much farther ahead to reduce as much as possible with whatever capital that you have. Any investment brokerage account that a person has should be considered as a tax loss harvesting account, because eventually every year if you can collect 20% of your portfolio value in harvested losses, eventually it's going to be having a decent amount of you know harvested losses in your books that you can reduce your taxes when you have that big bonus payday on your startup. So I would say, I mean, that's we don't have, I don't think we have too many clients or too many attendees of that category here, but if they are, they can also consider this as an opportunity to reduce your taxes. The goal is not, again, to avoid tax. If it's deferred, just like 401k, you defer it as much as possible at a much later point in time, so that your
Right.
tax that you would have paid is actually working for you at the market rate.
Absolutely. Here, we have one pre-submitted question which is quite similar from what kept getting requested for repetitively. It was around how Quantel's AI is helping identify tax saving opportunities faster. Like, why should I choose Quantel versus traditional advisory workflows?
So the first thing is the market research that needs to go in, right? Where are the growth opportunities? For a good tax loss harvesting basket of stocks, you need those basket of stocks, one, to grow at a good pace. We don't want to compromise on the growth of the portfolio just because you're harvesting loss. So one should not think that, oh, there is going to be so much loss in this portfolio, hence the portfolio itself is losing. No, that's not what we are saying. The portfolio as such should grow at a minimum at the market rate. That's a goal, right? That's what is a stated objective. While doing it, gives an additional layer of alpha by giving you that economic benefit of deferring to be able to claim the losses from the day-to-day transaction that you're doing. So that is the first thing, that we use a lot of research to create this growth portfolio that has the ability to go up and down. The second is, when you get out of a stock, you don't want to sit on cash. Why? Sitting on cash means you're losing the next opportunity of the, what goes down will eventually come back, remember? So I don't want to miss the boat on the coming back part. So I need to be able to invest on something else immediately. Why I can't invest in the same thing? There's something called wash sale rule that prevents me from investing in the same stock for the next 30 days. So you need some algos to keep a tab of like what you can invest, when you can invest, etc. So we have built all those proprietary algos of one, choosing the stock, choosing the exit point of a stock, choosing an entry point of the stock, of the next stock, etc., etc. So there is a sophistication there. The third one is the margin that we talked about. You don't do anything with your holdings, let it be there, and we just take a new amount of 30% or 20% on the account and trade. That also needs a little bit of sophistication there. So there are easy way to do it, there's a intermediate way of doing it, there is advanced way of doing it. So there's no one single way that you can do, but the results are very different for different types of tax loss harvesting.
Got it. There's one question that's come up. I hold large company stock positions. How can advanced TLH help me diversify without triggering a large tax event?
Yeah, so that's what I said. Don't sell your stock, keep your stock. We'll if we were to manage, we'll take a margin amount on that stock, 20% or 30%, depending on what we can take, depending on the size of the account. And that is a new cash that's created, right? That new cash is going to be investing in a growth, a list of growth oriented stocks. The goal of that composition, let's say we pick about 20 stocks, the goal of that 20 stock is to beat the benchmark. But while beating the benchmark, we are going to be doing this churn. When a particular stock within the 20 is actually having a negative return, you invested $100, now it's a $90, you've got a 10% loss. Take that loss, invest in something similar, kind of switching between a stock A to stock B as a single atomic action the same day, and then moving on to the next one, right? So this is a continuous process of thinking of like de-weeding your garden, right? You need to do that as a regular process of pruning to get the result that you want.
Got it. Thank you. And I think this is a very nice, honest question. So, where does Quantel AI come in? What can the platform do that a traditional manual effort cannot?
Manual effort is very, very tedious, right? You need the advanced technology to help it easy for you to navigate. You need a lot of time, as I said before. You need a lot of effort to do the research. So I'm not saying manual is not doable. It is, but the effectiveness of manual will not have the discipline that an algo can do, right? And that's where we come in. So Quantel can do it. So when we have these big ESOP accounts, RSU accounts that we, start managing, we don't manage the RSU, the actual RSU position. We don't even charge any fees on that one. That's just a shadow, right? That's just the collateral for the margin. So we only take a small sleeve of it to take it as a margin and manage the margin to give the results that you want. So your RSU account is really used as a placeholder to get the margin, because you can't get a margin with nothing invested, right? So you need something invested. So that's where Quantel can come in, is manage it efficiently with a specific objective of beating the benchmark on the sleeve that we are managing, and also giving you the tax loss harvesting capabilities. Like any and every amount that's harvested while beating the benchmark is great value add for you. And that's what we do.
Got it. I think, in interest of time, we'll take one last question, and thereafter, I would we take a close on this. But and the last
Also,
question that
sorry, one thing I'd say, Quantel is also a fintech app. So you can download the fintech app. There are a lot of calculators that we have. You can get a lot of market information about market, about stocks. There's quite a lot of AI that we have built for you. Most of it is for free. You can just download the app and start, using it, leveraging it. You don't have to pay any fees until you reach a certain level of usage. You can link all your accounts with Quantel for it to be analyzed by a systematic process to tell how good your portfolio is, etc. So quite a lot of features, and then we have AI built in for you to ask questions that you can get answers, which is factual, not opinion, but mostly factual in terms of why a stock is expected to do well based on the analyst recommendations. So it gives all the data, and then ultimately you can make your decision of whether it's you want to buy or sell, etc. Right? So it is downloadable as an Apple Play Store as well as Android version plus a web app version. All we need is just your email ID, no password required. The OTP comes through your email, so it's very secure in terms of what the system offers. So quite a lot of features are there, a lot of calculators there. One, we'll add the TLH tax loss harvesting very soon, but yeah, please download if you can, and it's for free. Yeah.
Thanks, Sham. Interesting that you mentioned that because the last question is quite related to that. So the gentleman asks, traditional TLH is already offered by so many robo advisors and wealth platforms which are available in the market. So why do you think that approach starts to fall short for HNIs, and where do you guys fit in? So I think
Yeah,
some
so
of it
when
you
you,
already
yeah,
covered.
so you're not looking, if you have $1 million portfolio, you're not looking to save $200 on your taxes, right?
Right.
It doesn't give you enough value for, if somebody says, I'll give you a 5 cent discount on a $50 bill. How does it sound, right? Would you want to take that, right? It's similar to that. The tax loss harvesting, which is 3% of the value. So let's take the $1 million example, right? So you have $1 million portfolio. You won't start with the tax loss harvesting of million. Let's say 100K, right? Easy example. 100K of the harvesting sleeve that we have. Now you've got $3,000 harvested by a traditional wirehouse tax loss harvester algo, all the robo advisors. Now 3,000 is your tax, your gains saved. What would have been your taxes on the $3,000? $600, right? That's your total value. Oh yeah, $600 is not zero. Yeah, you can get some value out of it, but do you want much higher value, 4 times more value than $600, or would you want 600? So that's where the difference is.
Got it. Thank you so much, Sham. Thank you so much for your time. And thank you, everyone, for taking out your time to attend this session with us. Please feel at ease to reach out to us. We're available at quantel.ai. We'd be really happy to help you and assist you in every best possible way we
Yeah,
can.
every scenario is, every person is different, every portfolio is different. So we can actually look at your individual situation, what stocks you hold, how effective we can do harvesting or not, what you can do. So there's no obligation whatsoever. You can just book a call. We have very few slots available. You can book a call, and one of our team members who are very qualified individual advisors, fiduciary advisors, actually will get on a call, talk about it in terms of what we can do if you choose us, or what you can do on your own if you want to do it that way. Thank you, Deepika. Thanks a lot. Really appreciate
Thank you.
all of you attending this call, this webinar. Thank you.
Thank you, everyone. Have a lovely day. Bye.
Yeah.